Hello and welcome to FidelityConnects. I'm Pamela Ritchie. The time has come for summing up this whirlwind year of trade in order that we might create context for the next one. There was a shock to the system and the way the world trades, with new and sometimes necessary guardrails appearing to be taking hold. Stimulus across developed countries also took hold via new channels in the form of the One Big Beautiful Bill, so-called. Spending on AI continued and expanded, and cash for new infrastructure is being carved into national budgets. The equity markets and bond market, says our next guest, produced by and large some huge winners through it all. Of course, there is a cyclical bull market still to question, walls of worry yet to climb, along with peeling apart the talk of bubbles. But staying invested and diversified in 2025 thus far has meant staying well ahead. Joining us now to share with you his extraordinary charts and graphs that map out the year of 2025 thus far is Fidelity Director of Global Macro, Jurrien Timmer. Warm welcome to you. Good to see you. Happy Monday.
Nice to see you as well. And don't let my extremely short haircut be seen as any kind of metaphor for the markets, because it's not. My hair cutter got a little trigger happy, but that's okay.
Looks very nice. It grows perfect for a Monday. We'll just remind everyone that's joining you here, Jurrien, today that this webcast is available with live French audio interpretation. So join us, of course, in either official language that you so choose. So let's begin a little bit of context, perhaps for last week. We're setting up for Fed meetings, the final. Bank of Canada is as well. Final rate decisions for the rest of the year. Is it a good moment to look back a little bit? We're not through it all yet, but it's by and large been pretty good for a lot of investors.
Yeah, this has been a year so far with 3 weeks to go, where everything, with the exception of Bitcoin, but it's only down a couple of percent, and for Bitcoin, that's a rounding error. But basically, every asset class that I track is up for the year. And it's a nice leaderboard. You know, bonds went from being a draw or a detractor of returns to actually a contributor. So bonds are up around 6-7%, which is a very nice result. Of course, gold is way at the top. That's fairly unusual as well. But equities, very solid performance. And at the top of the leaderboard are Europe, Japan, EM. And again, we've been talking about this for many months. Having a bigger pond to fish in, especially in an era of extreme concentration in the U.S. market, is exactly what we need, right? Imagine if the Mag 7 were the only game in town in the entire world, and everything was a trade on that or not. And that is a very, very difficult pond to fish in. But having the Mag 7 and their concentration, and then having an ocean, if you will, where you can go and harvest returns as well, is a very nice thing to see. And of course, one of the questions for next year is whether this was a one-off thing or the start of a more structural phase. And my guess is the latter. But in any case, for 2025, it's a great result to see. And again, other more alternative asset classes like long short, market neutral, absolute return, all been good contributors with low correlation. So it's really been a very good Sharpe ratio year where a multitude of assets have really done what they're supposed to do. And so in that sense, I think, despite all the drama politically and geopolitically, I think we can chalk 2025 off as a solid year for investments.
It's amazing. Should we pull up the leaderboard, the periodic table, perhaps, and sort of put it all into context because it is kind of incredible, as you say, shrugging off an awful lot of the concerns that have fed the headlines.
I don't see it in my deck, but perhaps it's in the other one. I was going to pull it up, but I'm not sure. That's an error on my part.
Okay, we'll leave that. Yeah. So that said, I think some of the questions of the shock to the system on the trade side, let's just sort of talk a little bit about that, because it's not that it didn't affect the markets, it absolutely did. It's just that when all is said and done, it's not as impactful as we thought.
Yeah, so if we pull up slide 1, that this is the both the cap weighted market and the equal weighted market going back to the start of the bull market in October of 2022. And you can see the different slopes, of course, with the cap weighted obviously being driven by the Mag 7, that's the blue line, and the equal weighted still a very respectable performance. But since that, what is it now, 38 months ago, since the bull market started, S&P cap weight is up 100%, S&P equal weight is up 59%. Both are obviously solid performances. But yeah, you can see there the tariff tantrum in April. That certainly was a big scare. And the recovery from that was, of course, equally impressive. But as you point out, it doesn't mean that it didn't happen, right? So the markets are always in price discovery mode. And before the tariff tantrum happened and the market was sort of just kind of hoping for the best, that the tariff stuff was, art of the deal, that sort of thing. It had to reprice itself when, the president held up that board on April 2nd with all of these reciprocal tariffs. And so the markets had to reprice. The markets are always pricing in whatever new information comes in, even if that information ends up being transitory. And so the market had to price in the market priced in a slowdown of earnings growth, and then of the tariffs sort of they didn't go away, but certainly the worst case scenario did not materialize, even though a negative scenario was priced in. And that's kind of how I think about why a market recovers, is that the information gets better and the market's priced in for something worse, and then it has to reprice yet again. And since that time, the markets have been, on a tear, especially cap weighted. The equal weighted has a more normal look to it, if you will. But we're ending, on a pretty high note, and there's a lot to like about the markets right now. Of course, we have the Fed coming up, and we'll talk about that. But we've also had the shakeout we've talked about in the last few weeks. We can see slide 4 shows the non-profitable tech index, and you can see how it kind of rallied out of that base pattern when the AI stuff really got some enthusiasm going. And then a few weeks ago, the tree was shaken, if you will. The low-hanging fruit was dropped out, the weak-handed longs, as we call them. Mm-hmm. And it's actually recovered quite a bit since then. But to me, that kind of shakeout actually is like a palate cleanser for going into next year. Because what we don't want to see is the market going so over its skis that you get into bubble territory. So I think the talk about bubbles that we've talked about, of course, at length for months, mm-hmm. I think we can kind of, it may still happen, but I think this shakeout has sort of pushed that further into the distance, and I think that's a good thing. Has it pushed it far enough into the distance where you get to the point of, you speak about breadth in your most recent report, but actually new leadership? Like it's shaken some of those out to allow the potential for new types of leadership to emerge. That could well be, but the way I think of it is, you have the Mag 7, which are, on solid footing, right? I mean, they're trading at I think a 32 PE, which isn't really that bad. Their rise over the last 3+ years, which is fourfold, has been almost entirely supported by earnings. So those are the anchors of the AI boom, let's put it that way. And then the other stuff are like the cats and dogs that are that people like to speculate in, whether it's nuclear stocks, which I'm not calling that speculation, but right. Kind of the more far-flung corners of the market, meme stocks, non-profitable tech, even Bitcoin miners, which have a hyperscaler kind of aspect to them. Those are the areas where the earnings haven't come through yet, and so when you get speculation, it tends to kind of take those corners of the markets to extreme levels. And so, to me, that's if we get a bubble, that's where you're going to see it first, and then you would see it, like, let's say, in the valuation of like Nvidia, for instance, which is trading at about 35 times earnings, which really isn't bad at all. So that's how I kind of think about boom versus bubble. I mean, if the leadership ever were to change from the Mag 7 to other sectors, that would be a whole different story. And I don't think
it's
that's
more like
going to
changing
happen.
underneath the hood of that, isn't it?
Yes,
yeah.
exactly. Yeah, you got the steady, strong earnings plays, and then you've got these peripheral plays, and that's where the speculation tends to be. It's hard to speculate on a $5 trillion stock.
Right,
you know?
exactly. That has piles of cash to do pretty much what it wants, and a lot of different situations. One of the things I want to ask you about, whether it is or isn't priced in for next year, is some of the tax and deregulation pieces of the so-called One Big Beautiful Bill. I mean, arguably, some of the tax depreciation story is in there, but the deregulation aspect of it, some we've seen, but some is still to be written, actually. So how could that be priced in?
Yeah, I mean, it's certainly a very powerful bill, and in some ways it's different from the TCJA from 2017, where in that you do have, obviously now the tax cuts, they're not new tax cuts, they've just been made permanent, but you have that expensing is a very powerful tool. So you definitely have a CapEx boom underway, and the deregulation side is equally important, especially now that the U.S. seems to be heading in a direction of state capitalism, if you will, just like China has done for years, and other regions as well. And so, you know, the U.S. government is picking winners and losers, which governments already tend to do, but especially now where you have this arms race, if you will, on AI, you know, that's a very powerful thing to see. But, you know, there's another angle to this. Actually, we can pull up slide 8, and we can pivot kind of towards the Fed here, where, you know, we do have a regime change about to happen at the Fed, and Kevin Hassett seems to be the big consensus choice now to succeed Jay Powell. And Hassett, of course, is a typical Trump guy, so he wants lower rates. But there's already a lot of buzz around what people are calling the privatization of the Fed's balance sheet. In other words, when the Fed wants to ease, it does QE. When it wants to tighten, it does QT. But it's all the Fed that's doing it. And what I think the new leadership or the kind of the Trump-friendly people on the Fed want to do, and certainly Scott Bessent is one of those folks as well, is they want to deregulate the banks and cut rates enough to create a steep yield curve. And the curve is positive, but it's not very steep right now. And if you can get that kind of 1-2 punch of a steep yield curve and less regulation for banks, the idea is that banks are going to buy a lot more treasuries. And what you see in this chart here, this is the chart I've shown in the past, but the move up in the federal debt since COVID, so $14-15 trillion of new debt has been added. And the Fed's role in that, which is the green, and of course in the early few years, the Fed, some people would claim, monetized a lot of that new debt, and then the Fed had to kind of, you know, respond to inflation. It had to shrink its balance sheet, and so there's a very large gap between the debt level and what the Fed owns. And then in the bottom there, you see what commercial banks own in treasuries and agencies, and you know it's taking share of the Fed's balance sheet, but compared to the debt, it's nothing, right? But so there's a sense of, okay, a steeper yield curve and an easier way for banks to own treasuries through these supplemental liquidity ratios and things like that could be a way for the banks to do the Fed's job if the long end of the yield curve needs to get cleaned up. And that's, you know, we talked about this 5 years ago. That's a straight page from the 1940s when, you know, the Fed was helping the Treasury fund the wartime debt during World War II. And it essentially capped short rates, T-bills, at 0.3%, and it incentivized the banks to basically ride the yield curve. So the banks sold their T-bills to the Fed, and they bought long bonds at 2.5%, and they were getting a 200 plus basis point spread, and it worked beautiful. So the banks, I mean, the Fed increased its balance sheet tenfold, but the banks did a lot of the heavy lifting. So I think this is a clear play here, and that's very much where deregulation is going to come in. So for the financial sector, it promises to really have some punch as well.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Two questions out of that, and the answer to both of them might be irrelevant. But one is, if you have banks that are much less regulated and therefore can spend, don't have to hold as much money on their balance sheets, they can go out there and buy things like treasuries. What happens then to the sort of the rise of private credit? Does it take some of the wind out of the sails there? Is it less necessary on some level? Maybe not. And the other is, does this help with the notion and maybe the fact that international buyers are trying to get away from the US dollar? Does it impact those as well?
It solves for both. I mean, private credit is obviously a very big story. It's a very large and growing part of the private kind of equity space or private credit space. And of course, it's been in the headlines recently because the private credit side seems to be funding some of the AI build out. And then it's a question of, how prudent is this? Or if you get delinquencies, how well positioned are private lenders to, play the role of a bank, right? And so it's an interesting space, and it's one that a lot of people are looking towards as, okay, if there's another meltdown in the financial system, like another subprime, will it be in the private lending or the direct lending market? And I don't have the answer to it, but by definition, these are private markets, and they're probably going to be more opaque. So it's certainly an interesting area. But yes, if the banks if the leash is taken off the banks, let's put it that way, and they can expand their balance sheet more, they can do that by buying treasuries, but they can also do it by lending more money, and then you get a multiplier effect because of the reserve system. So yes, it could boost the economy, and it could maybe take some share from the private lenders. And then on the other side, as you point out, if there is capital flight from the U.S., and so far we haven't really seen it. And actually, if we pull up slide 9, you can see how eerily quiet the dollar has been just in the past 6 months. Since we were talking about capital flight back in April. If you remember, if you look at that spike in what's called the CVIX, which is the currency VIX, like it's the VIX for the dollar. Okay. That spike was in March, April, when the dollar went down during the tariff tantrum, when it really should have gone up, and that was a major tell. Since that time, the volatility has declined, and the dollar has been sitting in a range. But certainly, if there was capital flight, and that would presumably create a term premium in the long end of the bond market, as there were fewer buyers than sellers, the Fed would have to step in. But again, the banks, you can think of them as proxies for the Fed because they are regulated by the Fed. The banks could do a lot of that work as well, like they did in the 1940s, and like they do in Japan with these big policy banks. So that's definitely something to watch.
I have a question. This is more sort of a fun question about the Fed, because there's a lot of very serious questions about the Fed, not least which their decision this week. But going back to sort of the forward guidance, less forward guidance, should we let people know what they can expect? Is it smooth markets? It seems like that is all doing a little bit of a toe-tapping dance here right now and trying to figure out what they should be expressing for a longer medium term. What do you think is going to change there, or will continue to change?
It's fascinating. So let's pull up slide 6. So we've had what I would call a monolithic Fed for decades, right? Yeah. Greenspan ran the Fed with an iron fist, the maestro he was called. Then you had, Bernanke, Yellen, and now Powell. And we've had a Fed where, there's going to be a dissent here or there of the 16 FOMC members. But generally speaking, the chair runs the Fed. So that's Powell. And the Fed mostly toes the line. But you could really see that change here. So again, with the administration wanting a more compliant Fed, if you will, because there's a lot of debt to finance. And a Trump-friendly like Hassett going in, presumably as the next chair, and he's well known enough that he's not that controversial. He's not like an MMT guy or something like that. And then of course you have Moran, you got a few other people, Waller, who are on the Fed who are already kind of in that mode. But you could see a Fed, and you see the dot plots there, which you mentioned, that becomes much more fragmented, where it becomes like a Supreme Court, where you don't have these near unanimous votes. You have highly fragmented votes where the chair has to kind of be the, he has to be the one to call it, but you might have a 9-7 Fed or something. And that's a whole different ballgame. You might see the dots get more fragmented.
Might you not see dots? I mean, is that a possibility? That's not, hasn't been there forever.
The next chair, yeah. I mean, the dots really were invented during the financial crisis, or in 2012, I should say, by Bernanke. No, they're not that old, but they were invented really to help the forward guidance aspect when rates were at the zero bound, right? The dots really don't do anything in a normal interest rate environment, other than, okay, these are 16 voices, but you get the forward curve is essentially the arbitrator anyway. But the dots were meant as another tool to let the markets know that the Fed was not going to move rates above, away from zero for long term. So that's really the main reason it was created. And you could argue with rates at 4 or 5%, it's no longer relevant. And certainly what the next chair might decide, if these dots are going to be a mess that he's not going to care about anyway, maybe they remove that forward guidance. It wouldn't surprise me. They really don't have a lot of value, to be quite honest, because again, you have trillions of dollars in the money markets already deciding or opining about where they think rates will be. And in a more fragmented Fed that's not kind of a monolith, frankly, no one's really going to know. And there is value in that as well, right? Because you could argue that there's a moral hazard side to telling the markets exactly what you're going to do over the next 6 or 12 months. And actually, there is actually a headline that just came up before we went on the air saying that Hassett says that this idea of the Fed guiding for the next 6 months is ludicrous. The Fed should just be watching the data.
I have to say that's why I'm asking you, because I was very curious what you thought of that.
Yeah. And so, he's not wrong, but the Fed wants to set the tone for what the markets can expect, but there is a limit to how much of that you can do.
Fascinating.
And how much of it you should do.
And how much of it you should do, yeah. And I guess just guiding the expectations of which tack you take, and it could be. A couple of questions rolling in here, a number of them actually. So bond sales, what are your thoughts on U.S. bond sales not going too well? Actually, they've held up in a lot of cases, but what do you think of bond sales?
Yeah, so we can put up slide 7 here, actually, which is a new chart. So the bond market in the U.S. has been very, very quiet. The 10-year is at 4.18, which actually is up quite a bit today, but it's been around 4.10, 4.20 for some time. But that quietness is not repeated in other countries, right? So on the left here, you have policy rates, and of course you see the Bank of Canada there, Bank of England, Fed, ECB, the Chinese Central Bank, Bank of Japan. And on the right, you've got the 10-year benchmark yield. And of course, Japan leaps out, right? I mean, the Bank of Japan has tightened policy a little bit, 50 basis points, but its yield has really skyrocketed. And Switzerland is way down, but Europe is up. The UK is the highest yield. So the US actually is relatively well behaved, and I'm not really sure why. I'm actually surprised both by the dollar and the US 10-year, how quiet they've been. And I do think that they are lines in the sand as we go into next year. But so far, I think the market maybe just assumes that Scott Bessent's going to pull, a rabbit out of his hat
when it gets close to that.
and figure something out with the debt financing, and that he's too smart to bet against. And, we'll see. But enjoy the calm while it lasts, because I do think that in the future, in the coming years, there will be occasions where something like that flares up. But right now, it's been very, very quiet, more quiet than I expected.
FidelityConnects has had a couple of conversations about EM, international investing, recently. And so a question is coming in for you. Seems to be lots of momentum in the EM space. It's just a fact. Do you agree? But which regions in that space are of most interest to you?
Well, China has certainly been hot, but EM is historically tricky because it's so fragmented, right? You've got LATAM, you got India, you got China, and they're all they're a little bit similar, but they're also quite different. But if you look at the US versus IFA developed and versus EM, they're all priced for relatively different things, right? So the US is priced for 11% earnings growth for the next several years, and that's reasonable if the AI boom continues. We're going to have 11, 12% this year. We had 11% last year. Expectations are for 14% next year. And so on that basis, the risk premium in the US market is around 4.5, which is not bad. If earnings were to kind of mean revert down to 6 or 7, the market in the US would be way over its skis. So it's priced for success, but that success has been materializing. So then you go to IFA, and there the market is priced for about 8 or 9% earnings growth, and it's at a risk premium of about 5.5. So that's fairly typical. Markets there are cheaper. They price in less growth. So I think there you're kind of in the same space. And then EM is priced for about 15% earnings growth. So the expectations are very high on the earnings side, but the PEs are low, which means that the risk premium actually is much higher than the US or IFA. It's more like 6 or 7%. And that's also fairly typical. So I would say EM is has a lot of upside because of the risk premium being low, but it's also pricing in quite a bit of earnings growth. And so I view the three buckets as very complementary. I wouldn't want to have all my eggs in one of those three baskets, but I would definitely have some eggs in all three at the same time. And whether you do that as on a global weighting or something else is obviously an individual decision. But like I said at the top of the show, it is nice to see the global markets participate in a growing business cycle and an expanding market cycle.
What would you say to investors just about the end of this year? I mean, there's sort of been the will there won't be a Santa Claus rally, and that's one piece of it. But we still have some time to go, a few weeks of trade to go. You never quite know how this could all go, and there is a Fed decision. Any just words of wisdom here as we march, not quite to the end, but getting there?
Yeah, so I would sum it up as the market's in a pretty good place now. A few weeks ago, I was a little worried. We were talking about bubbles, and things started to get a little bit unraveled on the more speculative side. But right now, we have solid earnings, rising estimates. We can pull up slide 2. The estimates for 26 and 27 keep rising. So we have strong fundamental support for this rally. The market is expensive. But at these earnings growth numbers that we're now pricing in, the market is not over its skis. And with the tree having been shaken of some of the speculative excesses, that kind of level sets the market also. So sentiment is not over its skis. Then you got the Fed with a 99% odds in the markets of cutting rates in December. And then we'll have to see if it's what's called a hawkish cut, where they say, okay, we're cutting now, but don't expect anything more in the next 6 months. So we have to kind of read through the tea leaves there. The long end of the bond market is quiet. The dollar is quiet. And we have a global bull market. So, I mean, to me, that's a pretty good backdrop. And then in 2026, we'll see where the lines in the sand are. Again, AI boom versus bubble. Bond yields, do they stay quiet? Do they go above 4.5? That would be bad. If they go below 4, that would be bad, because then you're talking about a slowing economy. But those are questions for next year. So I think for now the market has good momentum into year end.
Fantastic. We'll think of you when we hear the Fed speak, and we'll ask about that next week. Thank you, Jurrien. Have a great week.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.